and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, London-listed mining shares are on the move, with Rio Tinto falling, Glencore jumping, as the two discuss a tie-up to create the world's biggest miner. Now, the new entity would have a combined market value of more than $200 billion. The news today comes a little over a year after earlier talks collapsed. Well, joining us now for more on all of this is Mark Burton, who leads our EMEA mining and metals coverage. Mark, first of all, is it a done deal, or actually are there quite a lot of hurdles?
I think it's fair to say there are a lot of hurdles. These are very preliminary talks. I think the reaction that you've seen, particularly in the Australian market, to the initial news with Rio shares falling reflects the fact that there's very little known at this point as to the precise terms of the deal. And I think that if and when we get a full offer, we'll be able to kind of gauge more clearly what the viability of this deal might be. On the face of it, there are a few kind of long-running obstacles that have kind of thwarted a deal like this in the past. In 2014, they briefly gave it a go. In 2024, they did so again. Then I think valuation was one of the key issues, and I think it will remain so this time around. The logic for combining the businesses is to build. I mean, Mark,
this industry, right, your industry, it's never dull because they're kind of like in a M&A fever.
Yeah.
And we've heard BHP was trying to buy Rio. That didn't happen. They went for it twice. Rio's looking at other stuff. I mean, it's all about copper. Everybody wants copper because we need more copper for the energy transition.
Yeah, absolutely. And the Anglo-Teck deal, I think, has kind of sharpened that focus on copper, and throughout the industry there's kind of universal bullishness on the outlook, which is it underpins the logic for doing this kind of deal, but it also creates that potential valuation gap where everyone has very high expectations for the prize, and
it also means that others could come in. I mean, could they?
Well, I mean, it's such a huge deal that to buy Glencore as is, enter a bidding war with Rio Tinto, the number of interlopers is probably fairly small, but BHP obviously is the current incumbent, the world's largest mining company. I think that's the one that everyone would look to. It similarly is very focused on copper, like Rio Tinto. I think its investors are more open to a big bang acquisition that would very immediately boost its copper production, even though BHP is huge in copper already today, and that is another aspect of it. A fresh angle is just the intense geopolitical focus on copper as a scarce and incredibly important industrial resource. So governments will be watching on.
Mark, thank you so much. Of course, we'll have plenty more from this huge potential deal with Mark Burton. Now, it could be an especially volatile day for the markets as we wait for a pivotal U.S. jobs report and potential Supreme Court ruling on President Trump's tariffs. The December non-farm payrolls data is being seen as the first reliable reading on the economy after weeks of data affected by the government shutdown. Well, the Fed Governor Stephen Mnuchin told Bloomberg that his rate cut expectations for this year to boost the labor market.
I'm unsurprisingly the lowest dot. I'm looking for about 1.5 points of cuts. A lot of that is driven by my view of inflation. I gave a speech about this about a month ago in December at Columbia University. My view is that almost all of the excess inflation over target is due to quirks of how we calculate inflation.
Well, let's bring in Ludovic Subran. He's Chief Investment Officer and Chief Economist at Allianz. Ludovic, first of all, Happy New Year. It feels like we've had 3 months in the last week. So congratulations for making it to Friday. How big of a deal this is? I mean, this could, it could kind of change what equities do, given it's a big, important payroll number for the Fed to give us estimates of what they expect to do next.
Look, it will give us certainly a little bit more of information after what we call the fog of war when it comes to the data releases in the US over the past few months, right, including on GDP, on jobs, on inflation. So I guess we expect the non-farm payroll to confirm that the job market is far from stellar, and that will certainly continue to groom a bit of the dissent on the Fed board that there needs to be more cuts, what markets have been expecting all along, right? So this whole idea that it could be an additional 50 basis points of cuts in 2026 compared to what was expected initially. We are still in the camp that the US economy is still running hot, especially when you look at markets and when you look at growth. But again, those numbers are to be taken with a grain of salt. And it is very hard because remember, the Fed is all about data dependence. When the data is not dependable, you have a bit the situation now, which is going to be very politicized space. And you heard Steve Miran on his view, which is a very dovish Fed going forward, for sure.
You say the U.S. economy is increasingly running on two speeds. Does that accelerate and bifurcate even more?
Look, clearly the geopolitical situation, plus the AI transformation, plus the policy mix of the U.S. is exacerbating the K-shaped economy of the US. I mean, markets are really taking the lion's share of the growth created in the US right now, mostly because the expectations are in a sector that is a listed sector, and that is, capital gains trumping wage gains going forward at a time where inflation is not under control in the US. So yes, I do believe that this dual speed economy will stay and will continue to be a major impediment to the good conduct of policy, fiscal and monetary going forward for the US, for sure.
Ludovic, I mean, when we see everything that's been happening over the last week and actually executive orders, a lot of the things, Venezuela taking a lot of chunk of time, not being priced into any real market, does it change your outlook economically in 7-8 months if these things accelerate, if we have more shocks, or is the world strong enough to deal with it?
Look, clearly, from an investment perspective, we have a risk of tilt that is clear, mostly because, this K-shaped economy is not something that lasts often. So there is a risk of correction that is there. What would be the trigger and how would it be unfolding is very open. There is the talks of the AI bubble have been put to the back scene because now geoeconomics is back. But the question of hedging all of that is really, I think, what most investors should be worried about. I just give you one example. What's going to happen on the Fed and the May pivot of the Fed will be essential to understand anything from govies to credit to equity to the contagion that the US economy could have on the rest of the world, because the Fed is still the nexus of all the financial cycle, and the monetary and financial conditions have been behind a lot of the chutzpah on markets, right? So yes, it is something, the next months are going to be critical, but I have the impression we've been saying that for now a year or year and a half. So it's something that still keeps us a bit of a breath, or at least on our toes. And this is also a good place to make money. So this is a bit the double-edged sword of the situation. You need to be very agile, but there are good opportunities, and there are also things that needs to be completely scrutinized, yeah, for sure.
Yeah, Ludovic, I mean, for me, the two big surprises of 2025, apart from the fact that a third one is that Italy's so bad at football, but, the two ones is, first of all, when you look at tariffs and trade, actually the world moved on and it was fine. And when you look at, maybe some of the surprises, they were much better than expected. And the second one is also that if you look overall at the global economy, I mean, it's much more resilient than we thought. Does this continue into 2026?
To answer your question, you need to understand the reasons behind. I think on trade, for example, I still do think that there is a second layer to the trade cake that is going to be very visible and very bitter in 2026, especially as middle-class Americans fight against inflation in an environment in which the Fed will maybe be more dovish just because of the cast on the FOMC. So I'm not sure that it's completely done, but the reason behind is because the trade at stake is less than 10% of global trade. So the reason behind the trade war not being the tariff is 12% effective rate, but the amount of goods at stake is much less because the rest of the world has been rewired, right? So will that continue? I think so, unless, China really steps up the trade war, but they don't have an incentive to do so. On your other point, which is, this resilience on the growth numbers, I think we can explain this with the AI boom. In the US, when you look at the non-AI economy, it's a flat line. And so this is also something that is there to stay. Will it continue with the same cadence? I'm not sure. And so that's something that will certainly be a bit the headwinds of 26, is that those drivers, the policy circumscription and the AI boom will not be as much there in 26. That's why there is more of a soft landing type of situation, right? In the prices, at least, yeah.
We've been focusing so much on productivity for AI. We're starting to hear at the margins companies saying, look, I'm going to hire less. And maybe that's because of AI, because they need less people, but also because they're just investing so much on some of these AI models. Does that come into play in the economy this year, or does it take longer to look itself through?
Look, I think what is clear is that on the job market, for example, it's not AI which is in the driving seat. It's really more the need to continue to overperform market expectation when it comes to earnings. And so because there is a big need for CapEx for AI, it's eating everything on its way, right? Including the slack that you were able to keep on your balance sheet as you were a corporate that has been very cash rich for the past 5 years, let's put it this way. So I think that's a bit the indirect effect of AI. On the productivity itself, I think adoption of AI is strong, but it's not groundbreaking yet. And of course, because it's very new, and if you listen to people that are very expert on the topic, like Yann LeCun from Meta, he tells you LLM is only a very small part of what AI is going to bring. The non-language related change is yet to happen, and that would be much more grand in terms of productivity and displacement of jobs. This being said, there are sectors, especially in services, especially in clerk job, where I think you can feel already that for the junior hires, it's a dead end right now. So we're going to have a bit of this polarization embedded in the job market that is going to be very strong. But for the rest, I think the economy is mostly driven by where are the margins of corporates today, and they're still very strong, and they want to keep them strong. And so to defend the margin, they're ready to cut a bit on the cost. And so that's a bit what the job market is seeing. In Europe, same thing. Germany, unemployment rate up. It's mostly because of the industrial recession. So everywhere I don't see AI, I see more the soft landing phenomenon being behind the job market softness, including in the US, to be fair.
Ludovic, what's your take on China? We saw some numbers, CPI numbers, that were maybe a little bit better than expected, but are we going to still continue seeing deflation, which could be exported to the rest of the world?
Look, I think if it's not natural deflation, so driven by the confidence shock and therefore the real estate crisis and the fact that the real estate bubble pricked, and so it takes on average 8 years for a country to recover from that. And China is two-thirds of the way in, so there's still 2-3 years of strong deflation. But it's also organized deflation, and we see that on the trade dumping. I mean, at least in Europe, we're really on the receiving end of that, and you can really see that prices have been pushed down voluntarily on a series of sectors. That's the second China shock, and you can really see it, I think, in the transition goods. So I think China, to a certain extent, for the better, is continue to export deflation to the rest of the world. But there is an aftertaste, which is jobs at stake in Europe, for example. I think in the US it's less so, but I think in the retail sector in Europe, I mean, you see all the drama around Shein and so forth in Europe. This is a big issue. And so somehow people are happy because it's cooling down the inflation. I think energy prices are playing a much bigger role than China. But there is an aftertaste, which is this is continuing to displace a lot of manufacturing jobs. And clearly Europe is not yet at the level of industrial policy engineering that the US is when it comes to protecting their jobs. And this is something that is very political in the union right now. Yeah.
Ludovic, as always, thank you so much. Ludovic Subran, our Chief Economist and Chief Investment Officer at Allianz. Now, coming up, we'll dive deep into the world of organized criminal groups and what the fall of Maduro's regime means for geopolitics in Venezuela. All of that and much more to come with our next guest. This is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, U.S. oil bosses have been summoned to Washington as they come under pressure to return to Venezuela. All but Chevron ended their activities in the country when the late Hugo Chavez seized their assets in 2007. Bloomberg Originals has been looking at what sort of advantage that might give Chevron. Here's a preview.
The United States has carried out a series of strikes against Venezuela, announcing the capture of Nicolas Maduro and his wife.
Nicolas Maduro stood in federal court and pleaded not guilty to narco-terrorism charges.
Donald Trump said his military buildup in the Caribbean and destruction of civilian boats there was about alleged drug trafficking. But following the U.S. attack on Venezuela, another reason has taken center stage.
The oil business in Venezuela has been a bust, a total bust, for a long period of time.
Everything that we've seen during his second administration has been consistent with his view that the U.S. energy dominance is key to his agenda.
We're going to have our very large United States oil companies go in, spend billions of dollars, fix the badly broken infrastructure, and start making money for the country.
But one U.S. oil company is already there and has been for decades.
Chevron produces about 25% of Venezuela's oil today, is the largest investor in the oil industry and in the country.
We've been in Venezuela for the last 100 years. Our presence there, we believe, is important for the local economy, the regional economy, the people of Venezuela.
This is a story about the extent to which a US oil company is willing to go through the trials and tribulations of geopolitics in order to stay in a country that has the world's biggest oil reserves.
Chevron has virtually no competition. It has no oversight. And so it's really a very unique situation.
So how did Chevron manage to stay in Venezuela when everyone else left? And what role could it play in the country's future if Trump gets his way?
Well, subscribers can find out that question by watching the documentary on the terminal at Bloomberg.com and the Bloomberg Originals YouTube channel. Now, President Trump said he's planning to meet with Venezuelan opposition leader and Nobel Peace Prize recipient María Corina Machado as soon as next week. With us now, Irene, EMEA, Latin America Senior Fellow at the International Institute for Strategic Studies. Thank you for joining us so much, Irene. When you look at what happens next in Venezuela, a lot of the focus, of course, is on oil. How difficult is it to have some kind of peaceful transition where the U.S. gets what it wants, but it's a good deal for the people of Venezuela, too?
Good morning, Francine. Well, the short answer would be extremely difficult, right? There are so many uncertainties, so many pieces which need to come together. So on the domestic side, let's say that clearly we haven't seen regime change. We have seen, if anything, regime configuration. So basically, it's really the same people in charge, with the difference that is a very unstable, I would say, coalition of the three main power broker, namely the now interim president, Delcy Rodriguez, Cabello, who controls the Interior Ministry, and the Defense Minister, Padrino Lopez. That's complicated internally, I think, because the president is actually not controlling the military. So she will need the help of both Cabello or at the very least Padrino Lopez, who is now the defense minister. And clearly the dynamics, even in the past, among the three characters were already quite, in some cases, quite difficult. So that's one. Second one is that clearly you have a very fragile security situation in the country. As we know, Venezuela has been for many years a hub of transnational crime and not so geopolitical, transnational crime, I would say, including its involvement in the Shah. Yes.
Yeah, we're also getting, so President Trump is writing on Truth Social, so it usually is around this time. He has said two things so far, saying that they canceled the second wave of attacks on Venezuela, and he's also saying that the U.S. and Venezuela are working well together. Again, what would be the best transition in a very difficult situation? So who do you see in charge over the next 4 to 5 months, and what does happen to that oil?
So I think from what we see, the current Chavista remaining government remain in charge. I think it has to stay within very clear parameters set by the U.S., which have to do with obviously opening the oil sector to the mostly to the U.S. corporates, but also migration. I think is an important one. Probably will be repatriating more Venezuelan. You have the narco trafficking, which is obviously an issue, even if Venezuela is not central for narco trafficking dynamics towards the U.S., but more in general, it is important. And I think as long as really the government stay within those parameters, the U.S. government will work with it. But as I said, there are a lot of spoilers, internal spoilers, and also more general organized crime spoilers.
I mean, if you're a Latin American partner right now of the U.S., what would you be thinking? Does the region become much more unstable given the Don Roe doctrine? What happens next? Do you think, Irene, that the president actually wants not more influence, wants the rest of South America?
Well, I think it's very clear that, you know, in his kind of zone of influences, foreign policy, the Western Hemisphere is basically U.S., right? It's part of the America First. So I think that's something that has been made abundantly clear. The problem, I think, for Latin American partners and in general for the region is how to react to that. I mean, at the moment we've seen not much reaction apart from, you know, kind of declaration. But then again, there has been different level of success. If you look at the case of Brazil, for instance, Lula has not actually bowed down to Trump, and still, you know, tariffs have been removed. So I think it will depend really how close the country is to the U.S. in terms of economic and political and geopolitical position.
What happens next for the war on drugs? I mean, is there any doubt in your mind, Irene, that this is about oil?
Well, no, it's my mind has always been this is about oil, right? For Venezuela, definitely it's about oil because basically, as I mentioned, Venezuela is not important for the U.S. in terms of war on drugs, right? Fentanyl doesn't come from Venezuela; it comes from Mexico. Cocaine also doesn't come necessarily through Venezuela to the U.S. I think 8% only is coming through the Venezuela route to the U.S. So clearly, for Venezuela, it was about energy security.
President Trump is still going on, or still writing actually on Truth Social, saying Venezuela prisoner release is an important gesture. How do you see? How critical do you think that this is for policy?
Well, I think it is probably something that needs to be seen within the transition, which, to be honest, at the moment, I don't think, especially from Trump, transition to a democratic elected government is a priority, right? So I think it's probably more of a rhetorical kind of declaration, and it maybe comes more from Marcos Rubio.
When you look at, of course, Irene, you know, a lot of the things that a lot of the oil majors, I imagine, in the U.S. would want is, again, political stability. Do you have any insight on what kind of deals or terms they could get, or is it still just up in the air because the situation is very fluid and there's just also very rudimentary infrastructure to get the oil out to other countries?
Yeah, I mean, I think all those factors are important, but also I think what is if I were a corporate, what I would look at is also the state of the legal certainty, right? Because at the moment you have lots of investment from China and from Russia. There are contracts there for oil and also for natural gas and other resources. So what happens to this contract? And more in general, what happens to the contract which are now, say, established with new corporates, right? Are they going to be valid once there is a new government? What is the status? I think it's a big uncertainty for a corporate, I would say.
Yeah. Irene, thank you so much for joining us. Irene EMEA, they are Senior Fellow at the International Institute for Strategic Studies. Coming up, we'll talk to Dwayne Lysaght, a co-head of EMEA, M&A at JPMorgan, as global deals top $5 trillion in 2025. So what does that mean for momentum? That's next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Glencore jumps after confirming that it's in talks to be taken over by Rio Tinto in a mega merger to create the world's biggest mining company. Now, the U.S. president says he plans to meet Venezuela's opposition leader as soon as next week as the U.S. military prepares to hit drug cartels on land. Plus, TSMC, the go-to chip maker for NVIDIA, reports better than expected sales, reinforcing hopes that global AI spending can be sustained. So deal makers closed out 2025 with a staggering $5.1 trillion haul, the second best year on record, with huge takeovers across a number of industries. Now, many advisors anticipate that 2026 could set a new high for M&A as Wall Street optimism persists despite brewing trade tensions and, of course, talk of a market correction. Dwayne Lysaght, co-head of EMEA M&A at JPMorgan, joins us now. Dwayne, thank you so much for joining us. I always look forward to our chat at the start of the year because it gives us a good indication of why people would be merging, right? Is it to create value? Is it desperation? Is it just that bigger is better?
Well, first of all, thank you for having me on, and great to see you, and Happy New Year to you. Bigger is better. I think there's 2025 is a year of the return to the mega deals. Yep. We had probably about 40 in 2024 globally, 71 last year, and a record level of volume. And that really drove your 5.1 trillion up from 3.6 trillion in 2024. We see that continuing, Francine, for all the reasons you say. It's not scale for scale's sake. I think the market is rewarding focused scale, so the right type of scale, but it's also down to the synergies that can be created, the opportunities, the innovation, the attraction of top talent into bigger, more dynamic businesses. Yeah. They're the drivers.
There was an issue before about valuation, right? That people said, we want to merge, but actually you're expecting too much and I think you're worth less. Has this, is there a better match now because of some of the stress we're seeing out there? It could be geopolitics or just people feeling a little bit more anxious.
I think valuations in some ways have settled, allowing, or steadied, if you like, allowing people to strike kind of better combinations. Mm-hmm. The use of stock is on the increase versus cash, which does help you bridge that valuation debate. But I think more than anything else, I think there is a focus on driving growth into the long term and looking for those opportunities. And in that way, it does help you bridge that value divide.
What does Rio Glencore tell you?
I think it's back to that kind of the mega deal trend that is there for the right reasons in terms of seeking the right type of scale. But it is a continuation, think, of the theme last year. And I think that's going to continue into 2026 and potentially beyond as people are looking for opportunities to expand their business. Globally or otherwise.
Will it touch defense companies? I mean, again, it's strategic, but they're actually quite small in Europe. So if you had one big one, maybe they'd have more weight.
I think you've got the geopolitical overlay on that in terms of every government will have its own view as to what it needs locally or otherwise. I wouldn't try to predict what happens there, but you have to suspect that there will be consolidation on a country-by-country basis or within specific regions, depending on their alliances.
But is Rio Glencore, I mean, this is about copper, so does this go back to geopolitics or is it AI? Both?
It could well be both. I think we're going to see more of that type of deal in terms of scale transactions.
So in what sector?
If you look at the sectors last year in 2025, tech-led, industrials followed, FIG, healthcare, and consumer retail. They're probably, certainly 2 or 3 of those are my top choices, particularly tech and industrials. Combined, they're over 42% of global M&A volume. And that's where the bigger deals are getting done. And that is what has driven this real rise. That will continue in 2026, we suspect. Whether it goes in beyond that is another matter. But you have to see tech. It's at your AI point. Where is that AI money getting spent? Do I need to consolidate to really be the leader in the long term in that area? I mean,
I know I'm oversimplifying, but there's good M&A or bad M&A, right? So there's good M&A when you say, look, we want to be better, we are stronger together. And then there's bad where you think, actually, I'm in a spot of trouble. I'll be better under a bigger umbrella. What kind of AI deals do you see? Because I hear a lot of, when you look at valuations, people say there's going to be maybe a washout and the big companies that will be fine no matter what in AI will take over the smaller ones.
I think you see that in every developing sector historically. I could take you back to, 99, 2000, 2001, 2002, expansion of the internet age, and then the slowdown and then the consolidation. I would say that's probably happened most industries over the long term. Do we expect it necessarily to be any different with AI? Potentially not. Let's see. I'd love to be able to predict it as well, but I'm just not that good, I'm afraid.
No, you are very good. Are there more companies that try to go private? Will there be more in Europe, especially, which has been slower than the US?
Yeah, I think there will be. Europe had a good run of take privates last year. And it was a global trend, as you say. We think that, yes, that will continue. We see real value in Europe. And I think that is the opportunity there. Maybe a undervaluation in public markets provides the opportunity, particularly if as growth rates, and we expect growth rates will start to rise. And I think people getting ahead of that, buying businesses the right valuation with growth in the future, I think is actually a great opportunity. So expect more.
Cross-border? I'm glad you're sitting down, because cross-border, are we actually going to see cross-border consolidation?
We saw quite a bit of it last year.
Okay.
And when we looked at the numbers...
I need to sit down.
When we looked at the numbers at the end of the year, we were probably surprised by how much cross-border there actually was. It was a major driver of those mega mergers. Yeah. If I look at the 71 deals, I called it, about 18 of those or so were actual cross-border deals of proper scale. And that tells you kind of where we are. People are still thinking globally. I need that global franchise, and as much as we talk about deglobalization, it's actually continuing in terms of the globalization element is continuing in M&A. These companies need to have a global footprint, and there's some great value opportunities out there.
Are European companies looking for the U.S.? I mean, we've seen, again, the wave, right, because of politics and the Trump administration is, I'm going to invest a lot more in the U.S. I think they're also thinking, some of the coffee producers in Europe are saying, I need a base because that will keep everyone happy and I can touch that consumer. Are we going to see more of that in 2026?
I think we are. Actually, it's going to be a continuation of 2025. We saw quite a bit of it. In terms of the cross-border EMEA, say, into North America, was actually very strong, and vice versa. And the leading countries are the countries you'd expect. The UKs of the world, France, Germany, etc. We see that again as a trend. The interesting trend is how much is actually coming from APAC as well, and the Middle East. So, markets are evolving and developing and becoming, again, that more global, internationalized.
Dwayne, thank you so much for the terrific update. Dwayne Lysaght there, co-head of EMEA M&A at JPMorgan. Now, TSMC's revenue has topped estimates, reinforcing hopes of sustained global AI spending in 2026. We're just talking about that, despite concerns about an industry bubble. The go-to chip maker for NVIDIA reported a roughly 20% rise in December quarter revenue, based on calculations from monthly figures. Well, Charles Schrum, a technology analyst at Bloomberg Intelligence, joins us now. Charles, thank you so much. So what's driving the sales?
I think there are two reasons behind. First, I think obviously is because the NVIDIA's AI chip demand. It's ramping up the shipment of its new Blackwell AI server in the second half of this year. That drive a lot of the orders growth. And another actually unsung hero actually is from Apple. Apple's iPhone sales is actually quite strong, especially its iPhone 17. It has a great attraction in China market. Our numbers showing that actually it has grown more than 35% in the first 2 months of the fourth quarter, actually gaining back some of the market share from local competitors like the Huawei. So that's actually another reason for the strong sales growth for TSMC this fourth quarter.
And is this, growing trend likely to continue through 2026?
Yes, we believe that's definitely the case. So when we're talking about the revenue trend, we are looking at the wafer shipment volume and also the pricing. So for the volume, actually, it's not just the NVIDIA AI chips will drive the volume growth. It's also the other AI chip makers, designers like the Google, Broadcom. These people, they are also launching a new AI chips, and that actually demanding more leading edge nodes from TSMC. But also one thing maybe not many people are aware is actually these days the AI chips is getting bigger and bigger. That means more wafer volume output for TSMC. And another reason is actually the pricing. Actually nowadays actually TSMC is the dominant makers for these AI chips. There's no alternative, so you have an uphand in the pricing power.
Charles, thanks so much for joining us. Charles Schrum there, technology analyst at Bloomberg Intelligence. Now, UK retailer Sainsbury's is the biggest faller on the stock 600 as growth in food sales over Christmas was undermined by weak demand for clothing and electricals. Grocery sales rose 5.4% in the third quarter, but overall like-for-like sales fell short of analyst estimates. And Elon Musk's artificial intelligence startup, xAI, is burning cash quickly, with losses mounting as it spends to build data centers, recruit talent, and develop software that will eventually power humanoid robots. According to internal documents seen by Bloomberg, xAI reported a net loss of $1.46 billion for the September quarter, up from $1 billion in the first quarter. Now, it spent almost $8 billion in cash in the first 9 months of the year. And this month's episode of Bloomberg Tech Europe has been taking a deep dive into AI's impact on the music industry. The technology has been used for everything from generating melodies to enhancing vocals. But there are concerns that AI models have been trained using copyrighted music without compensating the owners. Tom McKenzie spoke exclusively with the Grammy Award-winning artist Will.I.Am about why he sees AI as a new renaissance.
The artists that are protesting have every right to, right? Because, say, for example, Coca-Cola wants to license your music, or McDonald's, or Starbucks, or, you know, some politician running for office. They want to use your music for their campaign. You have to license that, and the artist has to sign off on that.
But licensing of copyrighted music is possibly a solution for these AI models that are training. And so far, a number of them are trained, the allegation is, a number of them are trained on copyrighted music without compensating those artists. And licensing could be the solution.
Licensing is a solution. But what is the value of those recordings and those copyrights? So that's the heavy one. We licensed our music to Spotify. They don't value it the way that it should. Then that brings upon another conundrum. Like, a song is worth how much? A stream? So you could license it, but let's hope that the folks that are, you know, divvying up its value and its worth love it and appreciate it and price it for what it actually costs, as far as time. But the model is getting better and better and better. It doesn't have to learn from the past to create.
There's going to be a premium in terms of the human experience in this new AI world. Things like live experiences, live concerts, live sport. Is there going to be a premium for that kind of entertainment?
It's called lived experience. AI is not living. So when you go see yes, there's going to be lots of music. There's going to be AI bands. That's true. There's going to be like an AI freaking Bruce Springsteen. There'll be an AI Lana Del Rey. There'll be an AI freaking Adele. Yeah, and it's going to sound great. People like it. And you're going to go see it perform live. And the team that makes the live performance is going to be freaking, it's going to be dope. And then there's going to be human lived experience that you're still going to love. It's not doom and gloom for the music industry.
Well, Will.I.Am speaking to Tom McKenzie for Bloomberg Tech Europe. Now, Donald Trump's trade advisor has told Bloomberg that he thinks American industrial breakthroughs will eventually end China's dominance of the rare earths market. Peter Navarro says it's only a matter of time before Beijing's monopoly is over, and he's been speaking to Bloomberg's Michelle Hussein.
The China relationship is a very difficult one. China has been flexing its muscles now in Europe and India and the United States, saying basically, we're going to do what we want, and if you try to stop us, we're going to take away your critical minerals, because they think they have a monopoly on it. But that's just a matter of time. American innovation is going to quickly wipe away that innovation, that threat, that weaponization.
And you can listen to the full conversation between Michelle and Peter Navarro. Just search the Michelle Hussein Show wherever you get your podcasts. Now, coming up, we'll talk to Roland Rudd, global co-chair of FGS Global, about how businesses can navigate a fragmenting global order. That's next, and this is Bloomberg.
I think we have to earn that independence, and I think we have to be accountable for this independence. But the independence is critically important to make sure that the decisions are as unbiased as possible and only determined by the macroeconomic analysis and the anticipation of what monetary policy will do.
Yeah, because it can't be based on an election cycle.
There is a very good reason for that. Typically, monetary policy decisions have an impact down the road. If I hike, cut, or hold, it's not going to have an impact now, nor in 6 months' time, and probably not even in a year's time. So the passing of time is something that we have to take into account. And if in between you have an election cycle and somebody who says, oh, no, you should do this, you should do that, it will be completely counterproductive and counter-cyclical. That's the risk. So central bankers need to have time on their side, which is why most of them have long-term mandate and take decisions that have a target in the medium term, not in the immediate short term, because it's not going to work.
ECB President Christine Lagarde there speaking to me for the latest episode of Leaders with Francine Lacqua. It premieres today at 5:30 p.m. in the UK on Bloomberg TV. You can also watch it on the Bloomberg website and then on the terminal. Now, the post-war global order is fragmenting into spheres of influence as strongmen, leadership, and transactional relationships replace multilateral cooperation. According to FGS Global's Radar 2026 report, we have entered a rewired world defined by intensifying U.S.-China competition across the critical frontiers of trade, technology, and space. Well, Roland Rudd, global co-chair of FGS Global, joins me now. Roland, great to have you on the program. I mean, your report was kind of condensed in the week that was, right? Because we've seen it play out, but with a lot more force than maybe we were expecting. Are you expecting this rewiring to happen quicker?
Well, I think radical change is coming, because if you look at the numbers, it's unprecedented and not sustainable, the level of pessimism. You know, around 70% are saying they believe their country is incredibly divided, that democracy is fracturing, and that the next generation is going to be poorer. Now, the only sort of good thing about it is if you actually know what the problem is, you've got time to deal with it. And in some ways, it's not that surprising, because also in our report, 47% said they actually are looking towards leaders who have very clear, simplistic solutions. So you can see from the rise of populism and populist parties that there's a massive problem here, which our report shows.
But Roland, there's a danger that a lot of people in charge actually don't mind the division as long as they get 51% of the popular vote. So what does your report say in how this, where we end up in 1 or 2 years?
Well, so I think what the report is showing is that people are expecting significant different policies to come forward, because they don't think what's happening now is sustainable. And there's some very interesting things there for business in a way, because you wouldn't be surprised that, given the fact that we interviewed 175 prominent business and leaders and whatever their fields are, that they believe that the burden of taxation is falling too much on great companies, which are obviously employing people. But then the public think that by 80% think that taxation should fall more heavily on business. 64% want a wealth tax. I have to say, Francine, I think a wealth tax is coming, because the numbers of people wanting that have been growing every year, and it's always based on this extraordinary inequality. But it's important that businesses don't take the wrong sort of messages, because 5 years ago we had a lot of campaigns on ESG, DEI. The public is saying, don't be political, don't do these campaigns, but you've got to be agile, you've got to have a strategy, and you've got to be able to show that you stand for more than just profit.
Roland, I mean, you also say, this is a year of strong leaders and weakening institutions. What do weakening institutions mean for businesses?
Well, it's obviously bad news, because if people see the fact that it's better to have strong leaders, and that strong leaders are more important than institutions, that fraying of trust is obviously going to affect businesses too, because people who are prominent in society are no longer having the same resonance that they had before. So you have to actually try harder to get your message across, and you have to be able to speak authentically, and you have to be able to persuade people that you aren't just making a profit or just employing people, which is good, but that you are actually doing something that's beneficial for society.
2025 was also a year where you saw, data in the economy,
yes.
and the perception actually from chief executives was different, because
yes.
they had, by and large, okay businesses, but they said, but my neighbor's not doing great, or
yes.
my competitor's not doing great. Will it be different in 2026?
I think potentially it will be. I mean, one of the great things we're seeing here is, the US, of course, is less pessimistic based on the incredible rise in the market. What's underpinning that? AI. But you see, there's an incredible divergence between the elites who think AI is amazing. Donald Trump saying, we're 6 months ahead of China. But the public, who, by 40% in the US say they've actually known somebody who's lost their job to AI, and not surprisingly, around 80% in the US want to see greater regulation of AI. So there is a real dilemma here, and it's going to be very interesting how it's worked out. People used to say that AI was the sort of tentpole of the economy. Maybe it's a stick of dynamite.
Yeah, actually, it's a really great report, because you also have, you asked a lot of the senior leaders what are the most important issues facing their country. In the US, 42% said government corruption.
Yeah.
In the UK, 49% immigration. Where are we in the UK right now?
Well, I think probably the good news for the government is that the immigration numbers, which in terms of people who are concerned about immigration, have been huge, but are beginning to fall. And obviously, in terms of net migration, that also is beginning to fall everywhere. It's interesting that it's not the number one issue. The number one issue today is the cost of living, inflation and cost of living, but it's still there normally in the top three. So that is a slight sliver of hope for the government in terms of dealing with this particular issue.
Do you see us still want to be in the UK? I mean, there's been a number of things that were taken quite badly with the business community. The taxes, the non-DOMs. What do you expect for 2026?
Well, there are people who've definitely left because of the non-DOM issue, but there are also people who've arrived. Right, a lot of Americans have actually arrived because they don't like Trump's world, and so we're getting that type of boost. I think the taxation thing is sometimes overdone. There are some prominent people, quite often in private equity, who leave for taxation, but do people really want to live in Dubai? It's a lovely place to go and visit and do business in, but not necessarily actually leave London, which is, after all, the cultural centre of the world and one of the great business centres of the world. So I think that might be slightly overplayed.
Roland, when you look at, we're running out of time, but actually you also talk about this fierce battle for the future. I mean, this is energy. We've lived through this week. Do you see, this big, fossil fuel versus clean energy, fighting this year, or is it more just about access to natural resources?
I think it's going to be more access to natural resources. Interestingly, in the report, people will still see the issue of net zero as important, but they don't see the issue of environment and the problems affecting climate change actually adversely affecting them. So it's obviously gone lower down on the agenda. But I think it'd be a mistake to sort of take it off. It depends, of course, how you explain it, because actually people are in favour of renewable energies. They're just a little bit concerned about net zero because it's got a slight political tinge to it. But I think on renewables, people will support it.
Roland, thank you so much for joining us. Roland Rudd, the co-chair of FGS Global, with this new report just out. Now, the U.S. Energy Secretary Chris Wright is on Balance of Power at 10 p.m. London time. That will be a good conversation on oil, Venezuela, and actually what comes next. Up next for us, it's Bloomberg Brief, and this is Bloomberg.